Will Matheson has joined me here tonight. You could learn what his team is up to by heading over to www.mathcap.com. And if you're checking us out on YouTube, you're going to see that at the bottom of the screen, but it's www.mathcap.com. And we're going to be talking about some commercial real estate investing. But before we do, I really want to say thanks for joining me here tonight, because I know you're kind of at the end of the day and it sounds like it's been a busy one.
Yeah, no, look, I'm thrilled to be here. Thrilled to be here. Thank you for having me, Jack.
So Will, if you're on YouTube, you're going to see Will is a fairly young fella, and it got to start things off, Will, based on your age and how long you've been doing this. I mean, within a relatively short amount of time, you've amassed quite the portfolio in 4 years, probably closer to 5 now. How did you find your way into this real estate investing mess?
So how did we find our way into this? So my first job, I'm 32. I graduated college in 2014, and my first job was as a real estate broker at Marcus & Millichap, doing a lot of retail, some apartments and student housing. And that's a great first job, especially for wanting to get into ownership, because you're essentially paid to analyze real estate. A lot of people get into the industry from a totally unrelated one. They have to learn it all, on the side. I was getting paid to learn real estate. It was a really great life skill. It also taught me a lot about dealing with rejection for anyone who's ever had cold calling as a part of their job. I got told no a lot, but I did that for a few years, and my brother and I, we worked on the same team, twin brother Evan. And we said we wanted to get into ownership, so we left that. We went to Columbia University's Master's in Real Estate Development program. And, from there, we said we really wanted to get into being a sponsor, being an owner. We figured, we could spend 10 years climbing the corporate ladder to then leave and start buying big deals, or we could just leave immediately, don't have the golden handcuffs, and start small, which is what we did. We bought our first deal with a classmate before we'd even graduated. I was 25 at the time, and it was a duplex in Los Angeles. And from there, we kept scaling up. We bought a 6-unit property, 15 units, 24, 32, 32, 69. We got into some other partnerships, and we've been scaling up ever since.
Mm-hmm. Well, it sounds like you kind of went up the rabbit hole pretty quickly, because a lot of people start with that single family homes or a duplex. They kind of mill around there for quite a while with the aspiration of eventually getting into some larger properties. What type of properties are you focused on now?
Well, right now we're focused on 100 plus units, anything we can staff full time. When I rattle it off like that, it sounds like it was a lot faster, but we had a very deliberate strategy of, heavy value add, short-term holds, because we wanted to build a track record of start to finish projects so that we could attract new investors and show them, we know what we're doing. We're not just riding the wave upward or anything like that. So we, our average hold period on our first 7 acquisitions was probably under 2 years. We've exited. We're working on our 16th acquisition. 14th is the lead sponsor. We have 7 successful exits, average LPIRR of 40%. So it's not that we were able to just buy all of these deals and hold it. We had to buy and sell to build that track record, to deliver results for investors so we could get more investors.
It's interesting how deliberate you were on this. Is this something that you sat down right off the bat with your brother and kind of planned this all out?
So it was planned in a sense that from the beginning, we knew that we couldn't come into a market and buy a $20 million property. We were very self-aware, and I'm open to the idea that we were overly critical of ourselves, but we sat there and said, we're not going to come in and raise $4 million of equity on a deal. We're 25, 26 years old. No one's going to give us that money. This isn't tech. This is real estate. Some gray hairs really go a long way. So we knew we had to buy smaller properties. So we'd be doing a $300,000 equity raise, a $750,000 equity raise, $1 million equity raise. And one of the benefits of having such short-term holds is not only we were able to deliver for investors, but then we could turn around and go to them on the next deal and say, hey, I delivered for you here. Why don't you invest again? Tell your friends, invest more money. So it was deliberate, but it was also by necessity because we knew we wouldn't be able to compete in the larger space.
You mentioned heavy value adds. Are you still doing that type of work today?
We still do a fair amount of value add. Some of it's lighter, some of it's, more time controlled. When you're holding stuff for under 2 years, you really want to renovate as much as you can, as quickly as you can. Now, granted, if it's a 32 unit property, renovating half of it's only 16 renovations. But yeah, we still do value add for most of our portfolio, though we have bought some more stabilized properties.
Sure. Can you talk a little bit about where those properties located and what type of value adds you focus on?
So right now our properties are pretty much, or they are exclusively located in North Carolina, South Carolina, and we're currently under contract pursuing an acquisition in Georgia, Savannah, Georgia to be specific. As far as the value add is concerned, it depends on the deal. I mean, it's hard to renovate a property or an apartment for less than $10,000 at this point. Some projects we'll look at, if we have a really great assumption loan, we'll say, this is a great cash flowing property. We're going to hold it for 5 years. We bought a deal in August 2023 that we plan to hold for a while. And on the other end of that, there's property we bought in October of 2023. We plan on holding anywhere from 1 to 3 years.
So I've been curious regarding this then. You mostly mention on your website, or at least on the one sheet that they sent over, regarding student housing. Is that part of the investment plan here?
So we have done some student housing. We've partnered with some other groups, particularly in Boone, North Carolina, where Appalachian State University is. Going back to when I was a broker at Marcus & Millichap, it is one of my favorite markets. Just very high barriers to entry, a lot of demand because of the student population. But the majority of our portfolio is multifamily.
So as you and your brother have been growing your business, what have been some of the obvious pain points? What are some of the lessons that others could learn from your journey here?
Oh goodness, I have a list of, I want to say 5 things. I hope I can remember them all off the top of my head, but I'm very direct. When we started out, part of the reason we were doing short-term holds is because we had to learn a lot of what we didn't know that we didn't know. There's what you know, there's what you know you don't know, and there's what you don't know that you don't know. So we learned a lot of lessons those first 2 years. The things I always emphasize to people who want to get started in the industry are, don't do ground up construction. It's just a very different animal. It's incredibly risky. You don't want to over allocate your money into one specific property. You're in this to build a portfolio, not just own one property. You don't want to, I always tell people, you don't want to commit to like a 10-year project, because when you're starting out, if you're buying a 10-unit property and your goal is to buy 100 unit, 50 unit, 200 unit properties, hopefully 3 years into your ownership, that 10 unit is going to be a drag on you, and you're going to want, it's going to take up your time. You're going to have moved on to newer assets. So don't go for long-term holds. Kind of corresponding with that, you want to have very flexible debt. Yield maintenance was something we've only done once, I believe. Primarily, we were using fixed rate bank debt, 0 prepayment penalties. So we could get in, have a very stable asset, know what our loans were going to be. And then, as soon as we had a good offer, we could sell, deliver the returns to investors. So it's 4 of the 5 off the top of my head. I cannot remember what my 5th bit of advice was, but those are 4 things I learned.
Well, you probably have some lessons to share regarding working with family too.
Well, I mean, it's very easy for me. As I mentioned, my twin brother, Evan, is my partner. We sit across from each other in our office. It's a very long, narrow office. But I mean, I've got to say, I know some siblings who don't get along. Evan and I have gotten along. We've been best friends since, our entire lives. So it's been pretty easy for us, and we're both ambitious and have the same goals in mind.
So with that business with your brother, what is one of the biggest lessons learned?
Biggest lessons learned from working with my brother?
Yeah.
I would say it really helps to diversify your skill sets. Very early on, we were working together back at Marcus & Millichap in 2015, 16, 17. He very quickly kind of went down more of an analytics role. He would do a lot more underwriting, a lot more analysis, where I was doing a lot more calls, trying to bring in new business. And to a certain extent, that differentiation has remained, to the point where he would underwrite all of our properties before we started hiring and bringing people on. And that was as a continuity thing. We didn't want my underwriting and his underwriting because maybe I'd mess it up or I'd miss something he would catch. We had 100% continuity on the underwriting. And I would talk to all the brokers because it would be confusing for brokers if I'm calling them and Evan's calling them and they're getting mixed signals from both of us. So we really differentiated what we do, despite the fact that we're about as similar as any two people could possibly be.
It's kind of interesting how everybody kind of falls into their roles or the niches that they have their strengths in.
Yeah, I wouldn't have seen it coming, how it ended up working out, especially if you took me back to high school. Evan was definitely the more outgoing one of the two of us. I had better grades in math class, but we went to around college. He just really took to Microsoft Excel. He was essentially remaking the models at every company he ever worked at. Just incredibly proficient with Microsoft Excel and doing property analysis.
Well, that's enough bragging about your brother. What are the strengths you bring to the table?
Just it's such a hard question. My wife would say it's my charm. I mean, being honest, I spend a lot more time talking to brokers. I do more of the outreach to new equity partners. I deal with most of the legal aspects of the business, reviewing private placement memorandums, talking to the attorneys, et cetera, et cetera. But that's, we have pretty clearly defined roles. He has some of his investors. I have some of my investors. It's just a question of, how you meet them and where you maintain that point of continuity.
Well, a lot of people are, they get into real estate investing, syndication or raising capital and going after some of these bigger deals is aspirational. If somebody was listening to this podcast, what type of advice would you give them in order to get started?
So actually, that was probably my fifth piece of advice. Start small. I always tell people to start small for a few reasons. Number one, the less equity you have to raise, the easier it is to raise. People say all the time, and maybe I'm going to be disagreeing with you or some of your previous guests, but I think some of the worst advice out there is if you have a good deal, the money will come, like the equity will find it. I hate that advice, to use strong language. It depends on who you are. It depends on your track record. I could be 22 years old and find, the greatest real estate deal ever, but Blackstone's not going to say, wow, this kid's really sharp. Let me give him $50 million. They're not going to do that. I don't think they'd write a $50 million check. It's not worth their time. But I think the whole just find a good deal, the money will come. No, it depends who you are. It depends what your track record. It depends who you know. For some people, that'll work. So, if you start small, it's easier to raise the equity. It's easier to secure the debt. Also, there's less competition in the market. There's less competition for a 10-unit property than for a $20 million property. A broker selling $20 million assets knows every owner of a $20 million asset in the market. Sometimes you can find $1 million property in the local MLS or LoopNet or, pick a place. So that's one of the things. The equity's easier to raise, the market's less efficient, the debt's easier to procure. There's typically just more room for upside. So start small, build your track record, because as soon as you buy a smaller asset, as soon as you buy that first deal, let's just say it's 10 units, the brokers who sell 50-unit deals, you've just gained a lot of credibility with them. You're not someone who owns nothing. You've closed a deal. You've bought a 10-unit property. And as soon as you buy that, the next deal you buy is 30 units. That gives you more credibility again, and you just boost your credibility by proving that you have closed. I've seen a lot of people come into the industry and say, I'm only buying 200-unit properties. I need the efficiency. I need the scale. And they never get anywhere because they don't own anything. They have no track record. A broker doesn't want to gamble on them closing a deal. Quite frankly, I understand why. As a former broker, you show me proof that you've done it.
Well, you made me laugh there because I say that a lot regarding, first of all, there's no shortcuts when it comes to real estate investing. You got to find your path one way or another, and building that credibility, that it does take some time and effort. But the other thing is, I can't agree with you more. I say it a lot. The concept of finding the deal and the money will come is a complete snake oil as far as I'm concerned.
So I don't want to pick on a guy, but I spoke to a guy, I'm not going to name him, and he was asking, he had said that to me. He said, you find a good deal, the money will come. And I asked the question, who told you that? Because he was a part of a some group, everyone's meeting, talking about it. I'm like, okay, who told you that? And it's like, oh, it was this guy. And I'm like, how old is he? He's 55 years old. What did he do before he bought apartments? It's like, oh, he was a Silicon Valley CEO. Like, well, yeah, that guy has a ton of credibility. It might not be in real estate, but he has a ton of credibility. Like, he can get money. I think I met a former Goldman Sachs guy who he was very direct with me. He said, yeah, I mean, I have the world's greatest Rolodex. When I was getting started 10 years ago, I had no business raising the amount of money I was raising, but I had the Rolodex for it. So I could do it. Again, I was 25. I just wasn't going to get these checks. And, we've worked with family offices and private equity firms at this point, but that certainly wasn't going to happen in 2018, 2019.
Just to remind everybody, if you'd like to learn more about Will is up to, head over to www.mathcap.com. Found some value in what we're talking about so far. Share this episode with one of your investor friends. And if you're watching us on YouTube, give us a thumbs up and subscribe to the channel. So, Will, I'd be curious, you're in multifamily investing, some would call it commercial property. What do you think of the current economy, the current rates, and if we're going to see some deals because of things? We were chatting before hitting record regarding leverage and a few other things.
So where do I see the market going? So on a high level, I think we're at about as illiquid a point as it's going to be anytime soon. The Fed is not out here saying we're going to raise rates further. They're essentially pausing on cutting interest rates. So I think that will increase liquidity. You saw the articles from last month where Blackstone, or BlackRock, one of those two, can't remember, had essentially said, hey, we think we've hit the bottom. Let's get back in the market, which is going to give permission to a lot of joint or private equity shops to start deploying capital again, because nobody wants to be wrong. No one wants to jump too early. But if the leaders in the clubhouse say it's time to get back in, that gives everyone permission to get back in. So I think equity is going to get back in the market. I think debt is going to come down, maybe not precipitously, but any sign of relief from the Fed is going to be welcome. And this is where I'll get into my most controversial opinion on this, just to keep things lively. I don't think we're going to go back to zero interest rates, but I do think interest rates are going to drop considerably further than they are now, primarily because the last time interest rates were this high, it was 2007. It was pre-financial crisis, and the national debt was $10 trillion. I don't mean to sound like modern monetary theory, but I think there's going to be a lot of downward pressure on the Fed to lower the federal funds rate and interest rates, because we're not paying for $10 trillion of debt. We have to pay for $32 trillion of debt and growing. And we've already seen that the market will pay for negative. The German Bund was negative. Japan's had negative bond rates. There's still an appetite for American dollars. The EU isn't going to take over as the reserve currency. China's not taking over as the reserve currency. So, we abuse our position as the world's reserve currency. I have no doubt about that. But I think there will be downward pressure on the 10-year Treasury, in part because we can't afford to pay a higher interest rate on it, and that'll open the market up even further. I saved my controversial opinion. I really wanted to, engage you a little with that one.
Well, you're talking to somebody who is kind of on board with you on some of that, because this is the first time that I can remember where there has ever been any kind of rumblings around the U.S. not being the reserve currency.
Yeah. So my big thing on that is, I'm not going to sit here and pretend that, everything it's a land of milk and honey right now, but the competitors to the United States as a global reserve currency, I said the EU could have been one of them. They did a bond issuance a few years ago where I thought if that went really well, maybe that could shake things up. But if people think the United States is, really disunified and at verge of having a civil war and breaking up and shattering that, then we've got nothing on the EU. It's a lot more likely that the EU ceases to exist in its current form than the United States. And China would be the next closest country to replace us as the reserve currency. And, they have obviously a massive debt issue too. They have demographic issues stemming back decades where they just don't have enough kids. So, again, any problem the United States has, China has in a worse way. And also, after the last 4 years, I think it's unlikely that the world wants to make China the reserve currency. There might be a little pent up anger over, I don't know, something that happened in 2020.
Well, I think there's something to be said too. There is a bit of an incentive for inflation to be as high as it is right now because it kind of deflates the value of what we owe. I know you say we're trillions of dollars in debt, but the actual value of that, it's in a way, it's a small effort to try to control it a little bit.
Yeah, I mean I don't mean to sound cynical, and I don't want to go too far into pontificating about the future. I'm a big believer that people are bad about predictions, especially ones about the future, to paraphrase Yogi Berra. But which do I think is more likely to happen in the future? That the United States is going to stop spending tons and tons of money on all of its entitlement programs, which are the primary driver of debt, or we're just going to inflate the currency because constraining spending is too hard. Well, I would bet that we would inflate things, and inflation is good for debt, especially in real estate, especially in multifamily where our leases are all on 1 year cycles. Obviously the expenses go up, but the biggest part of your capital stack, the debt, we're a fixed rate borrower. I use fixed rate debt. I don't like floating rate debt. So, if your biggest expense is fixed and you have inflation, that's not the worst place to be in the world. It's a great hedge.
Yeah. When it comes to, I kind of lumped multifamily into commercial, but what I was saying, what I should have said is, commercial properties such as retail space, office space, those type of investments, we're going to kind of see something happen there because we're actually already seeing some banks in trouble because of their commercial lending, and the Fed just recently advised some of those banks to borrow from the Fed versus each other to kind of control some of that. So there's just I think we're going to see a lot of reuse of some of that space, and whoever can come up with the idea as to how to reuse use some of this vacant commercial real estate, I think is going to find a windfall.
So I actually think the vacant commercial real estate side of things is I think it's somewhat overblown. I've been hearing about the retail apocalypse that Amazon was going to bring to the country for the better part of a decade at this point. It was one of the biggest things I remember people talking about, 2017, 2016, that time. And obviously it's been bad for big box retailers, but one of my favorite retail investments is the strip center with, 4 to 8 bays that are all roughly 2,000 square feet. Like service retail, I think has a great spot. Industrial is doing very well. The majority, what is it? There's some statistic about the majority of office vacancy is concentrated in 10% of the properties. So there's a select amount of office that's doing very poorly, but a lot of office is doing fairly well. I can't remember the exact quotes on the office, but just I don't think we're going to be hit with a vacancy wave across the country, leaving retail and office completely. Certainly not industrial, but retail and office, the retail pain is concentrated in big box retailers. Like, let's use my generation. I said I'm 32. I'm a millennial. I'm not worried about net lease fast food restaurants going anywhere because, I'm a terrible cook. My wife's a great cook, but I'm a terrible cook. Like, that Taco Bell is going to be there for decades. I'm not worried about them. Mm-hmm. That real estate will be fine.
Yeah, I just don't, maybe that's anecdotal from my location, but I'm seeing a lot of office space. In fact, we have a very large campus here by a large corporation, and it's 3 buildings. They've consolidated down to 2 right now. They used to have over 3,000 people on this campus, and I think they're down to maybe 1,000. So this whole building is just sitting there vacant.
Yeah, I will say I've seen strange things like that, but again, I very, very informed of me not to remember the statistic, but the majority of office vacancy is concentrated in a minority of the properties. It's probably a Pareto distribution. 80% of the vacancy is probably in 20% of the buildings.
Yeah, that could possibly be. That could be possible. So just to remind everybody again, head over to www.mathcap.com to learn more about what Will is up to and see what you can take advantage of there. Before we jump into the rapid fire questions there, Will, is there a question or concept that you think we should have tried to cover in this main segment?
No, I mean, I feel like we tackled all of the big macroeconomic ones. Oh, all right. I've got one for us. I've got
Sure.
one. So what is going to happen with all the floating rate debt? What is going to happen with all the, I shouldn't specify floating rate, but what's going to happen with all the bridge debt? So it's been a couple of years now. 2021, debt was cheap. A lot of people are taking out floating rate bridge loans. You hear about distress in commercial real estate, at least in multifamily. A lot of it is not operationally driven. A lot of it has to do with having debt that used to be 4% and now it's 9% because it was floating over SOFR. So what happens with that? I will say I'm sitting here in Charleston, South Carolina. I have still only seen about a dozen properties sell for less than they were bought or less than they were purchased for, because a lot of lenders are just holding on to the assets. They're not ready to foreclose. They're not ready to take over. I've even met with some lenders. I asked them why these troubled assets, where they were the debt, why weren't they selling them? And they essentially said, we don't need to sell them. So I'll kick it over to you. What do you think we're going to see? I don't think the tidal wave of maturities in foreclosures is actually coming. I think lenders are going to wait.
No, that's very perspective. Before our conversation here, I would have imagined we were going to see kind of a tsunami of commercial real estate, especially that in trouble. But based on what you're saying, there isn't any incentive right now, and I would guess that they're betting on the Fed reducing rates and, in a way, recovering some of that. Like if the rates start to come down, the property value might increase, or at least stabilize the property to make it more attractive.
Yeah, I mean, one of the things I point out in terms of apartments specifically, again, I'll try to stay in my lane, but it's not 2008 where you had this oversupply of housing, a la The Big Short. It's not, we still have an undersupply of housing. So in multifamily, you do have bad operators and you have bad property managers who have not done well, but the amount of properties that are 60% vacant and their rent is dropping like a fly, that's not, I don't see that. And if you're not being forced to sell assets, then why are you going to foreclose and write them off your books and take the losses if you can just wait it out? And on top of that, this is the headline we've been hearing. It's like a fishing story. It gets bigger every time you tell the story, but the amount of dry powder on the sidelines, it's the biggest it's ever been. It's the biggest it's ever been. Well, as soon as they start getting into the market, demand is going to increase. Prices are going to increase. I think a lot of, some equity is just gone. It's lost, but I don't think the lenders are going to be, eating the loss necessarily.
Well, this has been a really interesting conversation, Will. I appreciate your time and insights on some things. What makes this special is that I rarely get to talk about these things on this podcast. So it's kind of it's been kind of a treat. I appreciate it. Yeah. Again, it is www.mathcap.com. And Will, if you're ready, we'll jump into some rapid fire questions.
I'm as ready as I'll ever be.
So you can get home for your supper.
My wife is waiting. I'm kidding. She's not waiting. Like, she's already eaten.
So what is a lie real estate investors tell themselves and sometimes to others?
I mean, I would say the lie a lot of sponsors are telling their investors is that everything's fine. Again, I don't mean to be doom and gloom. I don't think the bottom's going to fall out of the market, but a lot of people, if you bought a deal in 2021 with floating rate debt, it's hard. I don't care what your value add program is. It's hard to move from having a 4% loan and now that same loan is at 8% when it was 80% of your capital. That's just, there's going to be some pain on that front. It's very unfortunate.
Well, I don't think it's doom and gloom. I think it's being realistic. And when you're that transparent, and I'm guessing you're probably this transparent with those investors that you work with as well, They appreciate it, and it just adds to your credibility when the next opportunity comes.
Well, I mean, I'll say this. I think I mentioned it earlier. Part of our strategy as a sponsor is when we're the lead sponsor, we use fixed rate debt. It's the largest expense you have. I know people say property taxes are, but your debt's very expensive. I like to remove the uncertainty on that. We know what it's going to be every single month. That's how we structure our deal. So we haven't had to have this conversation. On top of that, we sold pretty much everything we owned at the end of 21, beginning of 22. So we've just been buying during the dip, which has been pretty great.
Do you have a book recommendation, or what are you reading right now?
The book recommendation I always give, so I don't say Rich Man, Poor Man, which I haven't even read, so I wouldn't say it. I always encourage Letters of a Businessman to His Son. This was actually given to me by the son himself. I think it's a wonderful book. Just of a father giving his son advice in business. My favorite chapter has to do with the son, or just getting a loan from the bank and complaining about, man, I wanted to get a loan from the bank. I wanted it so badly. They said no. They didn't think the business was worth lending on. And the advice is essentially, the bank gets paid to put out money. They do this for a living. If they're not willing to give you a loan, they're probably doing you a favor. Could just be a bad idea. That's something as, a buyer, as a sponsor, you never want to hear, but I think it's great advice.
That can have a double-edged sword. We had a bank that provided us a loan for a property, and we kind of relied a little too heavily on their due diligence, and it kind of backfired on us.
It's obviously failure has many parents, I think is the phrase. Or maybe success has many parents, but it's tough out there. It's tough. Not everybody bats 1,000.
If you could go back in time and give your younger self one piece of advice, what would that be?
I mean, I joked with you before the show, buy Bitcoin in 2010. More seriously, just you should always, always, always be looking for new investment partners every single day. I think raising equity is the hardest part of the business. It's what allows you to grow. It's what allows you to scale. So you've got to constantly be working on that.
Sure. And what single strategy, process, or tool have you implemented that has had the biggest time-saving impact?
Time-saving impact. I told you, it's having a twin brother. Anything I don't want to do, I tell him to do it. It works out phenomenally well. I've had that strategy working since before I was born, but I'm a big advocate of it.
Well, and since he's down the hallway from you, he's told me that he just puts a mirror in there, and you still think he's working hard at work. Well, this has been great. I appreciate the value you brought to the show. It was a great conversation. Again, it is www.mathcap.com. That's going to be a clickable link in the show notes. Really great to meet you, Will, and hope you'll come back again sometime.
Thank you for having me, Jack.